Welcome to the Daily Brief, where we'll go over the action in the market for Tuesday, December 13th, and then see how things look for Wednesday, December 14th. We saw quite an interesting day. The CPI came in weaker than expected, or cooler than expected, and the market immediately reacted to that in a positive way. We saw a huge gap up at the open, only to quickly hit resistance and start coming back down. And instead of having a really powerful up day, we had a positive day, but not as powerful as, at least it's when it started out. It looked like it was going to be a lot more powerful in Tuesday's session. Now we have the next variable that comes into play, and that's the FOMC announcement at 2 p.m. Eastern. What's going to happen with that? Well, there's three things that we need to always look at when we're trying to figure out what the market's going to do. There's only three things that can happen. The market could go up, and that's if the whole stock market sees what the Fed says and does as positive. The market could go down. That's if they're more hawkish and the market doesn't really like what they say, and so we go down. Or the market can stay about the same, where it doesn't really react. At least it might react, but then it ends up pretty much right back where we started. We'll have to see what scenario plays out. One or two, meaning up or down, that's a little easier to deal with. I know that if you're long in positions, that can be more frustrating, but at least it's something that is known if you're trying to enter into new positions, either long or short, or maybe get out of some positions that you have. The most frustrating one oftentimes is the most likely one that will happen, and that's where we pretty much end up where we started. We saw the solid up day on Tuesday. Maybe we'll fall back on Wednesday and end up not really deciding anything. That would be very frustrating, but it's happened before, and it's been happening a lot in 2022. It would be nicer if we get some kind of resolution, at least going from now until the end of the year. So we'll have to see. And it's pretty much up for grabs how the market is going to react to this. All right, let's go back and talk about what happened. Right at the open, we had a huge gap higher above R3. We don't hit R3 all that often. I had to actually put it on the chart. That was at 40.83. We kept going up, but then boom, we ran right into resistance at 4,100. As the day went on, prices started to decline, and pretty aggressively declining. We went back to R2, which was at 40.28. We fell down to R1 at 40.09. And then we almost came back to the unchanged level. Not quite. We were just within striking distance of the unchanged level. So that's really big to see that big of a retracement. But when we finally hit bottom there with the intraday session, we rebounded back above R1. We got up to R2, and then we closed just a little bit below R2. So we were up 0.73% on above. I'm so used to saying below average volume, but there was a real pickup in volume in Tuesday's session, so we were above average. The technicals, they're still switching over more positive. We have some negative things that we're focused on, but the market could salvage itself, if you will, especially if they see and hear and take what the Fed says as being more positive. The inverse of that could also happen. They could take it as more negative, and we could slip back into that more negative stance as far as the market is concerned. But that's the real fixation right now for the market. Here is the intraday chart where we gapped higher. It was up over 2% right at the open. We got all the way up to 4,100 before then falling back below R3. This was more, I didn't measure this out, but this might have been some kind of fib retracement level. We tried to bounce back up off of that. Didn't really happen. Then we really came down below R2, R1, almost to the unchanged level before rebounding back above R1 and up to R2, fell back down to R1, and then closed down below R2. Yeah, it was a pretty exciting day because we've been seeing some pretty boring days lately. So what are some comments that we can make? The CPI was cooler than expected. It's still quite high on a bit, especially when you look at it in the context of what's happened over the last 20 years or so, 30 years. this, it's still very high, but at least it's coming down. The announcement on Wednesday will come out at 2 p.m. Eastern, and then that'll be the announcement. The market will gyrate around in reaction to that. And then at about 2:30 p.m. Eastern is when the press conference starts, and the market will react to that and any key phrase that Chairperson Powell says. The dollar declined and interest rates fell during the session. So we're seeing markets kind of acting not really strange, but you would think with interest rates falling would be okay. But since the Fed is going to be raising interest rates at the meeting, you would think the dollar might have a little bit more support, but it's been having a lot of trouble as of late. And the S&P was up about 2.8% right after the open, and we were above the 200-day simple moving average at 40.34. Then we hit that resistance at 4,100. We ended up closing below the 200-day simple moving average, and we're right on top of pretty much the 200-day exponential moving average. Small caps continue to underperform, and we still have our yield curves that are inverted. That hasn't changed. Sentiment is still positive. It hasn't really moved all that much. And the NFIB Small Business Optimism Survey came out. It increased a little bit from 91.3 up to 91.9. Here's the CPI, and I'm going to take a couple of minutes and just go through. I have a couple of charts that I usually show right when we get the CPI. It came out at up 0.1% on a month-over-month basis. They expected it to be up 0.3%. So that immediately said, oh, inflation's starting to tame. Then if you take out food and energy, that's what they call the core CPI, it was up 0.2%, where, again, cooler than expected at 0.3%. Then on a year-over-year basis, we're looking at 7.1%, where last month we were seeing it at 7.7%. So that's been coming down. And the core is at 6%, where the last time it was at 6.3%. Our trend is still slightly positive. It is starting to turn up a little bit, so it's strengthening, but we're still below 20 right now. Our bias is positive. We've had 2 up days back to back, but our momentum, I'm still keeping it mixed because we're right on that 200-day exponential moving average. We don't know what's going to happen in Wednesday's session, so I'm kind of keeping it. We could go either way at this point, but the last couple of days have been more positive. Here's the chart that we've been looking at to compare 2006 through 2008. That's the green chart here, where the white is what has been happening, updated as of last Friday, where we have been sticking to this fairly decently. Are we going to continue that? Are we going to be able to break to the upside and forego this weakness that may develop, at least according to this model? Or are we going to follow what this model says and see that weakness going into the end of the year? There's the VIX also still at a relatively low level, but if we start to fall, this could really spike up like it's doing in this chart. Here's the CPI, where the red or yellow line, and they kind of combine together to make orange. This is how it was up well over 8% and then falling back. Now, if you go back to how this was calculated in 1990, we would be up at about maybe 11% or so, because they changed the way that they calculate the CPI to make it not seem so extreme. But this is the way they did it back in 1990. Now, the real telling one is this next chart, where if they calculate it the way it was calculated back in 1980, we would be at 15.23%. Not quite double, but getting close to double what we were actually told in the CPI report. So that's kind of a little bit scary and not necessarily surprising from a real life standpoint. Right before the meeting, this was the final reading that we'll get on. There's a 79.4% chance that the Fed is going to raise interest rates 50 basis points or 0.5%. There's still a little bit over 20% of the market is saying that we might go 75 basis points. It would really catch the markets off guard and be quite negative if they did raise it 75 basis points. The the Fed is supposed to do what the market is telling it. And according to this, they're expecting a 50 basis point move. What the market can't really control is what Chairperson Powell says and what kind of stance they interpret the Fed having. And if it's more hawkish, that will be negative. If it's more dovish, the market will take it as positive. If it's kind of a little bit of both, then the market's going to remain rather confused. We still are seeing small caps underperforming the S&P, and they really fell yesterday and they continue to fall. This is more negative because in a good, healthy environment, we want to see small caps doing well and quite often outperforming the S&P 500. They're just not doing that now. They're underperforming. Here's our trend showing that we're turning back up, but we're not above the moving average yet. We are below 20, so we're in a trendless environment. The green line spiked up, the red line is coming down. That's helping this line to gain some strength. But until we cross above the moving average and then finally go back above 20, we're still in what can be considered a trendless or sideways market. The BPI didn't really participate all that much. It's still positive. It's getting back up to extreme now, but it hasn't become as high as what we saw in the recent past. So you could say this is positive because it's giving us quite a positive reading. You could say this is negative because we saw the S&P really spike up, but the BPI didn't follow along with that. Here's our double exponential and triple exponential moving averages. We had been right on the 50-period double exponential moving average, which had been providing support. Well, after Tuesday's action, we're now right at the triple exponential moving average, and that is currently providing support. The equity put call ratio actually went up a little bit, even with the real strong up day, especially at the open. It gave a lot of that back. And as we were going down, down, down and retreating, that's probably, I'm just guessing, that's probably when you saw this spike up because folks were starting to say, oh no, here we go. We still have the Fed tomorrow. I better hedge some things, or I'm going to take advantage of the downward movement by buying some puts. We're still declining, however, with our 5-period simple moving average, even though we're at a pretty high level right now. And here's the daily chart where we came and actually broke through this trend line, but then came back down below it. And we closed right about on this longer term resistance level, or we opened right at this longer term resistance, went up and then came back down. And you see the red line here, that's the 50-period moving average. And we actually broke down below that. At the bottom, we see where volume did really pick up and was above average. This moving average tree chart shows us how we're pretty much right on top of the 200-day exponential moving average, but most investors use the simple moving average. So we're going to be watching that. And can we get above it, stay above it, and then close above it? And the new highs, new lows, starting to show a little bit of improvement with the spike up that we saw. The new highs started to break out. So we're turning up slightly with the 5-period and pretty much flat to going up slightly with the 10-period. This is another change, and this is kind of a biggie. This is the stop and reverse system, SAR, where the dots had been above the bars, and that's negative. Well, after Tuesday's action, the dot ended up going below the bar, so it's now switched to a positive signal. Our fib levels, nothing really decided here. We're above this 61.8% retracement level at about 4,006 or so. We closed at 4,019, almost at 4,020. So we still have some resistance above where we're at 41.23. Then longer term, again, we're above this longer term fib retracement level here at 50% at about 40.20. We're just right at that level currently. Can we break back above that? We broke through it earlier in the day only to close down below it. And then looking at the weekly chart, just to show you, we're right on top of this 40-period moving average, which quite often equates to the 200-day simple moving average. But since they're right on top of each other, I thought I'd bring this chart up. So what's our outlook then for Wednesday? The technicals, they're still negative overall, but they are improving. And they're starting to turn more positive, but we're not full-blown positive yet. And all of that could change if the market reacts negatively to Wednesday's announcement. We have the weekly MBA mortgage index coming out, import and export prices. These are not real biggies, just give us some insight economically. But then we have the rate decision that will be coming out. That's the big one. So we have the whole list of geopolitical events, but for right now, unless something else flies in from this list, inflation and interest rates, which are producing growth concerns, that's the fixation of the market. Our scenarios can't really go with the down scenario yet because the technicals are improving and they're starting to turn more positive, even though we're not trending yet. We can't really go with the up scenario, even though things are looking a little bit better. So we're still in this trendless environment. And we didn't really see a lot of follow through positive action from the sector rotation. Our positive setups did help because they're more moving average based, but looking at growth versus value, didn't really see anything big. Even though growth had a fairly good day, it gave a lot of that back during the day. So we're still going with this sideways scenario where the ADX, although it is getting stronger, is still below the moving average and it's still below 20. The green line is moving up, and so we are positive. So our conclusion, the S&P is negative, but improving, and it's starting to turn more positive, but we're not there yet. We'll have to see how things play out. Short term, negative and improving. Intermediate term, negative and improving. We're still below the 200-day moving average on a closing basis, so we're still negative overall long term. So thank you. Have a really good day, and we'll just have to sit and see how the market reacts to what the Fed does and says, and then we'll fall back and regroup and evaluate things at that point.